On February 5, 1937, Joe Louis was born in London. That date anchors the financial DNA of Boohoo Group CL. The timing is not accidental. It sets a baseline for capital allocation that prioritizes survival over sentiment. Louis entered the fashion retail space not as a designer, but as a buyer. He understood one fundamental metric: margin compression. If you buy low enough, you can sell cheaply and still profit. This is the foundation of modern fast fashion. Boohoo Group plc was founded in 2006. The company targeted a specific demographic, consumers aged 16 to 30. This group demands novelty at low prices. They do not care about heritage, they care about speed. The founders, Mahmoud Kamani and Carol Kane, built the operational engine. Louis provided the capital. The division of labor was clear. Kamani and Kane handled the merchandising. Louis handled the balance sheet. The business model relied on a data-driven test-and-repeat approach. In English, that means design cheaply, produce in small batches, and only scale what sells. This reduces inventory risk significantly compared to traditional retail. Traditional retailers forecast demand 6 months out. Boohoo did not. They reacted to real-time sales data. This agility allowed them to capture trends before competitors could even cut fabric. The central question of this story is how that speed created a fragile supply chain. The answer lies in the pressure applied to external manufacturers. Boohoo did not own the factories, they owned the brand. Boohoo imposed a new policy requiring a leg time of 6 weeks or under for all garments. This is an aggressive constraint for garment production. It forces suppliers to operate at maximum efficiency. The penalty for non-compliance was severe. Boohoo introduced a 5% price cut for every week an order was late. This financial lever ensured that speed was the only acceptable variable. Suppliers in Leicester began to adapt. They hired more laborers and extended working hours. The goal was simple: meet the 6-week mandate to avoid the 5% penalty. The unit economics favored Boohoo. They shifted the cost of speed onto their suppliers. The suppliers absorbed the overtime and the efficiency losses. Boohoo kept the margin. This is where Boohoo makes the classic late-stage venture mistake. They assumed that contractual leverage was equivalent to operational oversight. It is not. Contracts do not prevent sweatshops. Oversight does. The boardroom logic was sound on paper. High turnover of inventory meant high cash flow. Low fixed assets meant low risk. The financial model was robust, but the human element was ignored. The Leicester factories operated outside standard labor protections. This was not an accident. It was a structural requirement of the speed model. In July 2020, Boohoo's share price fell 46%. This was the first major market correction. The trigger was allegations of malpractice at Leicester factories. The market reacted to reputational risk. Retail brands survive on trust. Boohoo's trust was tied to the conditions of production. Those conditions were about to be exposed. A BBC Panorama investigation was released in September 2010. The report found that Boohoo broke promises to make its clothes fairly and ethically. This was a direct contradiction of their public stance. The investigation used undercover footage. It revealed the reality of the 6-week mandate. Suppliers were under immense pressure to deliver. Secret filming at supplier Leicester Clothing Limited revealed staff being told they may need to work late into the night. The hours were unpaid or underpaid. A colleague of the undercover reporter admitted to lying to suppliers to secure cheaper deals. This confirms that Boohoo's purchasing team actively manipulated costs. The strategy was simple: squeeze suppliers until they cut labor costs. The suppliers' only option was to reduce wages or ignore regulations. Both are illegal in the UK. Boohoo's initial response was to deny the allegations. They claim the report was based on a single visit. This is a common deflection tactic in crisis management. The denial failed because the evidence was corroborated. An independent report by Alison Levitt QC found that allegations of poor working practices were substantially true. The Levitt report was a death sentence for the old model. It proved that the ethical breaches were systemic, not isolated. Shareholders panicked. Standard Life Aberdeen sold most of its stake in Boohoo after finding the company's response to worker allegations inadequate. This signaled institutional abandonment. The stock price had already crashed, but the selling intensified. Investors do not like uncertainty. They like clear exits. Protests from shareholders forced Boohoo to cancel a scheme that would have paid its 3 top bosses £1 million in bonuses. The board had to yield to activist pressure. This is the classic boardroom humiliation. Executives lose their upside while the business faces existential risk. It resets the power dynamic. In November 2020, Boohoo appointed former judge Sir Brian Levison to provide independent ethical oversight. This was a damage control move. They needed an external validator. Levison's appointment signaled a shift in governance, but it did not fix the underlying supply chain. It only polished the exterior. Boohoo launched its Agenda for Change program aimed at improving supply chain practices. This included new audits and training. The Agenda for Change was necessary, but insufficient. The structural incentive to cut costs remained. As long as the 6-week mandate existed, suppliers would find ways to bypass rules. Boohoo's executive chairman, Mahmoud Kamani, required approval for buyers to confirm any brand new orders. The centralized control was an attempt to tighten oversight. Centralization slows down speed. Kamani was trying to have both. He wanted the margin of fast fashion and the ethics of slow fashion. The data shows this is impossible. A legal claim on behalf of 49 investors, including the California State Teachers Retirement System, was filed against Boohoo Group. The claim alleged breaches of the Financial Services and Markets Act 2000. The lawsuit focused on disclosure failures. The lawsuit alleged that Boohoo had known about the risks and failed to disclose them to investors. The lawsuit alleged what investors characterized as securities fraud. The legal exposure added to the reputational damage. The company was no longer just a retailer. It was a defendant. Despite the scandal, Boohoo's financials remained strong. The demand for cheap clothing did not disappear. The business model still worked for the consumer. The crisis was an operational failure, not a product failure. Consumers still wanted the clothes. They just did not want to know how they were made. Boohoo pivoted to acquisitions. In January 2025, Boohoo bought the brand and online business of Debenhams for £55 million. This was a strategic bet on scale. Debenhams was a legacy department store. Boohoo saw an opportunity to import its fast fashion agility into a traditional retail framework. The acquisition was cheap because Debenhams was distressed. Boohoo used its cash reserves to buy market share from a dying competitor. This move cemented Boohoo's dominance in the mid-market. They now controlled multiple brands and a major high street presence. But the ethical questions lingered. Could a company built on speed ever be truly ethical? The Agenda for Change was a start, but trust is hard to rebuild. In December 2021, Boohoo Group opened a physical Debenhams.com beauty outlet in the Manchester Arndale shopping centre. This is the final image of the post-mortem. The store is a tangible symbol of a brand trying to rebuild trust on the ground. It brings the online speed model into the physical world. Lewis and his team survived the scandal. They did not apologize profusely. They adapted, they centralized control, hired auditors, and acquired competitors. The question remains, is it possible to fix a business model built on speed without sacrificing the very efficiency that made it profitable? The data suggests no. The incentives are misaligned. As long as speed is rewarded and ethics are regulated, the gap will persist. Joe Lewis remains one of the wealthiest men in the UK. He built an empire on efficiency. The scandal was a tax on that efficiency. The final lesson is not moral, it is structural. Boohoo's rapid ascent was undermined by a supply chain strategy that prioritized cost-cutting over human dignity. Speed without ethics is a liability. The market eventually prices in the risk. Boohoo paid that price and then adjusted its portfolio. The story ends not with a resolution, but with a continuation. The supply chain remains opaque. The audits remain external. Lewis continues to allocate capital with precision. He learned that reputation is an asset class, but he did not change the engine. The consumer still buys the clothes. The supplier still works the hours. Boohoo still ships in 6 weeks. The cycle continues.